talk about all of this with Emily Roland. She is co-chief investment strategist at Manulife, John Hancock Investments. Sorry about your Red Sox.
I know, it was tough.
It's tough. All right. Emily, outside of baseball, it's one historical stat, okay? But I like it. It's better than it. Markets usually fall 7.7%. Is the direction of this market up?
I mean, Brian, nothing can stop this market right now. It's all been about momentum. It's been about technicals. It's been about embracing the pockets of the market that are up. And we've seen this almost relentless dip buying take place. And now we've got valuations at almost 23 times forward earnings. So markets are priced for perfection in a not so perfect world.
That makes me nervous, what you just said.
Yeah. Well, the good news about it is that the denominator of the PE ratio is more important to us. That's the earnings.
That's going up.
Earnings in the United States, the engine is on right now. And that's really important because we have the highest quality companies with the best earnings revisions here in the United States. You think about speculation, just go overseas. You look at the MSCI EFA. It's up 30% this year in U.S. dollars on 1% earnings growth. Chinese stocks are up almost 40% on 0% earnings growth. Some of these European countries have negative GDP, and they're sporting some of the best performance
We've talked
ever.
about it. Slovakia, Slovenia, Poland, Austria, Germany, Taiwan, Japan, China, Taiwan. I said Taiwan twice. Those are all going up.
Yeah.
Why?
It is out. So as a market strategist, I never want to say we don't get it. But in a way, if you're somebody that focuses on the macro puzzle, it's hard to square with the performance. Now, we've seen this sell America everything trade since the height of Liberation Day, whether it's stocks, whether it's bonds, whether it's the U.S. dollar. Of course, the dollar being down 9-10% year to date has been very much accretive to the performance in some of these countries. But to us, it's the trend is your friend, and that's the best friend of a short-term investor.
Well, trends, listen, stock market tends to go up, 72, 77% of the time, so that's fine. Are you worried at all, Emily, that the denominator, as you say, is all based on one thing, that AI behemoth?
Yeah.
That's all we talk about every day. And without that, I don't know how much earnings growth there is.
Yeah. It is a concern. And, frankly, without AI, the economy wouldn't be doing as well, and the market clearly would not be doing as well. But when I look for, over time, we're huge believers that stock prices follow profits. And when you're looking for profits right now, you're finding it in United States technology companies. But what you want to think about doing right now is what we're drafting the market. So the equity investors are on a straightaway right now. They're in fifth gear, whatever you want to call it. We are right behind that lead car. We're participating, but we're owning higher quality stocks with better balance sheets within the technology sector, up in market cap, staying away from those more speculative corners of the market, participating, but being mindful that some mistakes can be made.
Did you bring all the racing references just for me? All the cars, straightaway, fifth gear, turns?
I did, and I was really nervous that I was going to get some of the turns.
No, it's great. Listen, as a 30-year car racer, I get it. But here's the thing. I also know if you're going down that straightaway, unless you're a dragster, even dragsters eventually slow down.
Yeah.
And there's stuff that happens to the race car, and there's things in the road. What is a risk right now? What do you guys perceive? You're John Hancock Manulife, right? Your job is you're risk averse, as they might say. What are the risks to manage through right now? Well,
I think the biggest risk in markets right now is that there is no risk. And that's what we've been talking about today. So the risk is that there is some type of froth, a bubble that gets burst. And it's a key reason that we're diversifying within equity exposure. Mid-caps are a favorite area right now. They have a completely different sector composition than their large cap counterparts, with areas like industrials and regional banks that are benefiting right now from M&A. They're trading at a 30% discount.
Why does anybody care? Nobody loves Jan Brady, Peter Brady, right? Like, they've got things to offer, too.
Well, I was about to tell you that we like income in bonds, too, but definitely nobody cares about that.
But why don't they care? Those are valuable parts of the market. We got a guest on coming up later on in the show. He's going to talk about investing in small and mid-cap companies with his buyout fund. There are great companies. Amazing companies. I talk to their CEOs, they're frustrated. They're like, it doesn't matter if I grow earnings 20% a year, Brian. Nobody seems to care.
Right.
That's a problem.
It is a problem, but it's not a problem for investors that are looking for something that's on sale. It's really hard to find anything that's on sale. I'm a big shopper. I'm always looking for bargains. Mid caps in the United States are one of the only places we're finding it right now. Everybody used to come on your show and say, buy international stocks because they're cheap. Guess what? They're not cheap anymore. U.S. mid caps are the place. Small caps were a little bit concerned because of some of the profitability and debt there. The mid caps in the United States are the sweet spot.